Hi guys, welcome to this edition of Closing Bell on Moneycontrol. I'm Nandita Khemka. What a thriller of a Thursday it turned out to be for the markets. Of course, a Fed-fueled rally really playing out across global markets, and of course, India was no different. We saw the Nifty hit a fresh high of 21,200. In fact, the Bank Nifty also very close to that 48,000 mark now. Looks like 50,000, could be a reality on the Nifty Bank Index in the next couple of months, so to say. But if you look at some of the sectors that did well today, of course, aside of banks, you had the Nifty IT pack, nearly 3.5% kind of gains coming in there. Realty as a pocket also, 4% kind of a gains coming in on the realty index. All the sectoral indices were in the green. In fact, top 5 or top 4, stocks on the gainers list dominated by IT names like Tech Mahindra, Wipro, Infosys, HCL Tech, which mind you hit a fresh record high today as well. And IndusInd Bank, Bajaj Twins, and on the losing end, you had the likes of Power Grid, HDFC Life, Nestle, and some of the pharma names like Cipla, DRL, etc. But of course, clearly a Fed-fueled rally. The message coming in from Fed Chairman Jerome Powell, of course, looking at 3 rate cuts in the coming year, even though the market was factoring in more than 3. But experts believe that if there is a severe recession in the US, we could look at rate cuts of somewhere around 5 to 6. Of 25 basis points each. But to figure out how to navigate this leg of the bull run, let me bring on board my guest for today, Gurmeet Chadha, Managing Partner and CIO at Complete Circle Wealth, joining in this afternoon. Great to have you on the show, Gurmeet. Look at the markets, all the risks, the major risks are out of the way. You had the political uncertainty. We saw the state poll results, clear mandate there. You had GDP figures way above expectations. Now the rate hike cycle coming to an end. There's a clear message coming in from Fed as well. So all the risks out of the way. Would you say that the grand finale of this rally is yet to play out going forward?
So I think I must congratulate all investors who stayed invested in the last 3-4 years. Anything that could go wrong has gone wrong, starting from COVID to US yield curve inverting, debt ceiling issues, Russia-Ukraine war, Israel-Hamas, rate hikes in US. I've never seen so many negative events in a short period of time, and I think markets have kept climbing walls of worry. So I think the message is clear. You have to be, you have to be in the game if you want to, make money in the markets. Yes, you can rotate. Yes, you can be tactical. Yes, you can, rebalance things, but you have to be in it. Avoid taking extreme calls. The second thing is the biggest risk comes when everything looks hunky dory, and the best time is when there's a lot of negativity. So I think right now, since nothing is visible, I think the risk levels are going up because you suddenly feel that everything is right. Right, and this is the time you tend to make mistakes. You confuse, your returns with your intelligence rather than the luck. And so I think you've got to be more balanced now. It's like, when you score a century, you need to take a fresh card. I don't think so we have scored a century though, but obviously we've hit one milestone, which is 21,000 Nifty and 70,000 on the Sensex. Take fresh card, reduce some risk in the portfolio. There is some froth in small and mid caps in few pockets. There is some fraud in names where stocks are just going up on order book alone. Execution can be long drawn. So just rebalance a little bit. I personally think that you have to slightly rotate towards sectors which are more out of favor now because the market rotates very quickly, and also add some maybe bonds also to the portfolio. I'm not saying that because I'm bearish in the market. I'm just saying that interest rates will come down next year, and yields are pretty good, and even a bond portfolio can deliver, hypothetically about 10% plus. So just rebalance things, take fresh guard, and just now focus more on risk. If you do that, I think returns will continue to fall.
Right. Of course, you mentioned about, the mid and small cap indices, in fact, the pocket of the market turning a bit frothy. Would you say that now is the time to swap exposure to large caps? Do you think large caps will outperform going forward, given the fact that quite a few names haven't really participated? They are yet to participate, even though they may have started, but a lot of catch up to do there. So do you think when you talk about rebalancing, take some profit out of the mid caps and perhaps park money in large caps? Is that the strategy one should adopt?
I'm not saying all large and mid caps are frothy. So let's say if you are doing an SIP in mutual funds, it's fine. Just continue. I don't think so. But don't get excited and keep topping it up just because last 1 year, 2 year returns have been good. On a stock portfolio, I think some rebalancing can be done, especially where multiples are, let's say, very rich, like 80, 100 P multiples, or if you're holding some financials, the price book is, let's say, 5, 6 times, or if you are in, capital goods or let's say, capex related themes, if EV by EBITDA multiples have been really shot up in double digits. So I think some bit of rebalancing is there, but just swapping everything with large cap also is not a great idea. We look at it this way, market leaders are something you need to be focused more on with reasonable valuation. So let's say a largest cable and wire company may not necessarily be a large cap company. The largest depository is a mid cap. The largest ethanol player is actually a mid cap. So it's not that all mid and small caps are that, but yeah, wherever things have gone up too quickly, and sometimes it's more than the fundamentals warrant. So I always say question outperformance as much as you question underperformance, because the risk is more in outperformance than in underperformance. And yes, I agree. In few pockets, large cap valuations are reasonable. Look at, for example, Reliance and HDFC. They are probably at 18,050. You look at the entire IT pack, especially large cap IT. Mid cap IT has done quite a bit. If you see the large cap IT, they're probably still 15-20% away from the peaks. I don't see a lot of pharma names being really euphoric, especially the CDMO API names. Agrochemical has been under a lot of stress. So it's a bit of theme rotation, a bit of moving out of expensive places where you made very sharp returns in a short period of time and focusing towards blue chip. And as I said, I don't mind adding some long duration bonds also in the portfolio. Gives you dry powder and potentially can give you double digit return if yields keep coming off.
Right, when you speak about themes, for the next year, at least till the general elections, how would you really, approach different themes? Would you bet on a pharma? And if you would, would you bet on India-focused pharma? Because we've seen USFDA concerns resurface for the likes of Dr. Reddy's, Cipla, very recently Laurus Labs as well. Should one really look at some of these India-focused pharma names now?
So you got to have a dual approach. One part of the portfolio is a core portfolio. You don't tinker it much. You want to play for 5 years, 7 years, 10 years stocks which you think can compound at 20%. So I don't want to disturb the core portfolio, which essentially could be two-thirds or 75% of the portfolio. The satellite portion you can, as I said, do some rotation. So I like sectors which have really fallen out of favor. And there's a lot of negativity. I think IT is one sector which can make a comeback next year. The commentary could change. If you remember, everybody is speaking of digital when COVID happened, right? And all IT companies then started getting all digital contracts. Some of them gave a split of digital revenues being X percentage of the overall, revenues and the order book. I think a lot of that will now start saying the AI related deals they strike, right? A lot of things can change. So that's why you saw the reaction in IT, which came very aggressive today once the Fed showed signs of pivoting. Also, I think the template is that interest will come down and rates will come down. Any challenge to this template can bring a lot of volatility. So I don't think so that inflation can surprise also in between. So we should not just assume that there'll be sharp rate cuts and inflation will fall and US economy will really slow down. So play with that template, but as I said, have some dry powder. So I would look at out of favor names like IT, like some of these CDMO API names in pharma, not necessarily generics. I may also look at, as I said, agrochemical names. They've really beaten very hard with China adding capacities. Small part of the portfolio, especially satellite part, can go there. But don't disturb the core portfolio too much. This market can be, as I said, its timing has two legs always. It's exiting and re-entering. The second part is the most difficult. A lot of people exited pre state election results. And look at that. Nifty is up 1,500 points. It's, if you missed 4 or 5 best days in a year, your returns are reduced by 50%.
Right, there's been a lot of euphoria around PSUs, of course, PSU banks as well. But, vis-a-vis private banks, they still have a lot of catch up to do when it comes to valuations. As I said, as I asked you, is there more steam left? So, on one hand, as I mentioned that, private banks, some of them haven't really played catch up or they are yet to play catch up. So, should one balance out between PSU banks and private banks, or should the tilt be more towards PSU banks?
No, I think the former is better. A balanced approach is better. So look at this way. The largest bank, private bank today, is available at 15 times earnings, roughly 2.2 times book. SBI, the largest PSU bank today, is available 9 times earnings, 1.2 times book. Bank of Baroda is probably 6 times earnings, almost book value. So even in PSU, you should be a little selective, because accidents, again, as I said, I use the word accidents can happen. In one quarter, you may suddenly find slippages going up, some kind of NPA emerging, and so got to be more balanced. I think NBFCs you got to be a little careful in near term because RBI is worried about unsecured lending. NBFC with very large unsecured lending book, they've increased risk weight. They've increased risk weight to banks who are lending to NBFCs. So near term, some pressure can come. So you should be more focused on HFCs if you want to play the non-banking space more, and a mix of private and maybe top PSU banks. Just be wary of just go on that something is just zero point 0.5 book. It is also zero point 0.5 book for a reason. Because of the history of accidents happening in the bank balance sheet. So have a more moderate approach there. And there are some other niche names in insurance, in depositories, in exchanges, which are a quasi play on growing equity culture in the country. So have a very balanced approach there. Don't make it PSUs versus private kind of a trade-off.
Right, and looking at the entire consumption basket, how would you play this theme? Would you say premiumization is a better bet now because rural demand, yet to make a recovery? It's been fairly patchy for so to say. So would you say premiumization is how you should play the consumption pack now?
Absolutely. I think maybe a mix of both. So if you see premiumization is already playing its role in two-wheelers. Look at the way a TVS and Bajaj have performed vis-a-vis a Hero over a longish period, right? Hero is still struggling to get the 125cc plus variant right. And now, like cars, the SUV guys have done well. So a Tata and M&M have done much better than a Maruti, right? Similarly, in two-wheelers now, more than 60% sales are on the premium side. Same for, look at food business. The ones who got into branded food, and premiumization, like Tata Consumer, like ITC now, the way their FMCG business is going up, they've scored much better than a Dabur and some of the other names, right, in the FMCG pack. So I think premiumization is there. Also, the movement in terms of unorganized to organized segments where, so pulses, foods, spices, dry fruits, breakfast cereals. We are moving towards premiumization. We are moving from unorganized to organized. Similarly, in areas like, let's say, tiles, huge unorganized markets, sanitary ware, huge unorganized markets. So we're seeing that premiumization playing out and unorganized to organized playing out. I think some of the FMCG companies could come back in focus with rural economy recovering. We already saw two-wheeler companies and their holding companies also, like TVS Holdings, doing well. I think some of the farm equipment names can make a comeback. And I personally think agrochemical will do well with election season approaching. I think you will see a lot of initiatives by government related to fertilizers, related to herbicides, related to more subsidies probably there and more targeted, focused activities there. And that could bring that sector also back in focus.
What about your what are your thoughts on the new age tech companies? The likes of Paytm, of course. There has been negative news flow around that company. It has reduced its loan ticket size. In fact, it's focusing on high end, high value loans now vis-a-vis the low value loans, right? So we've already seen the stock come off somewhere around 40% from its highs, right? So going forward, anything that's exciting you in the new age space, the likes of Zomato, Paytm, of course, we have seen, as I mentioned, negative news around this particular counter. Honasa is one for that matter, just listed. How would you view this entire space now?
I have a disconnect with this word new age. I think a Tata Technology, a Geo Financial, they are as new age as as some of the names you take. So we track it as a basket in terms of companies really disrupting. So we like KPIT and Tata Technology for the disruption they are doing in digital engineering and embedded software. Right. We also, Bajaj Finance was a disruptor when it really started doing digital lending, using, credit metrics to give loans, pre-approved loans. So, few names we are tracking is Tata Tech. Again, valuations high with the listing we've had. We like Geo Financial. Zomato, I think after a long time, we are seeing the GMV also picking up, the take rate getting maintained. And even Blinkit, they've said that next year they should be a bit positive. In fact, this festive season, Blinkit really did well, including, the innovative scheme of delivering gold bars and gold coins during, the festive seasons. I would like to watch it out because that space is now more or less a duopoly. Others have tried, including Food Panda, Uber Eats, Amazon tried in Bangalore. So I think that place is sorted. So I want to watch it. I mean, the only risk is ONDC, which right now is not there, but it may come. It may challenge the take rates, which at 22, 23% may not sustain. So that's something we are tracking. We haven't really started investing in it. Paytm, I would like to wait out and see what the impact this has of recent RBI and their decision to not go below 50K on the unsecured loan on the overall numbers, because lending was doing the heavy lifting for them and not the payment business, right? So I want to watch before taking a call on that. Once if they can demonstrate that they are doing well, because they are more like a broker, they are more like a co-lender and not taking as much risk on the balance sheet as the small finance banks or the NBFCs and the banks take. So these are the two names we would like to watch out for. The other one we are also tracking is Policy Bazaar. That again is a aggregator company. So we are watching it, but we haven't really taken a plunge to invest in.
Right. What about the realty pack? It has already seen quite a big up move, and now with rate cycle easing, do you think we are in to see a fresh leg of up move coming in here?
So I think you've got to be again selective. I think in here also the premiumization is playing out well. The affluent segment, if you look at DLF, kind of pre-sales they did last year, and they're also guiding for 20,000 crore pre-sales this year as well. Their rental portfolio is holding up well. Occupancy levels are about 88, 89%. So that gives them significant debt reduction. I think the balance sheet looks. I think RERA's impact is now getting visible on stronger builders, whether it is DLF here or Oberoi or Brigade and some of the better names. So you got to go geography wise here. But I'm pretty constructive. So not, we like DLF. But as I said, I've all been saying this for a few years. I like more the building material space. That is which I think is more secular. So, the tile makers, the sanitary ware makers, the cable and wires, the plywoods, etc. I think that's where we see better return ratios, more secular growth, and the home improvement theme also playing out. Reality is fresh home sales. Home improvement is even getting your existing homes done, making them better. So that's a more secular play in my view than playing the realitism.
Right, a couple of last questions to you. FII flows, they've started picking up once again, but now yields coming below that 4% mark. It's a pretty positive factor, right? So do you think 2024 will be more front-ended when it comes to foreign inflows in the run-up to general elections?
Yeah, so that's a risk for people who have been out of the markets, right? So just to give you figures, they sold $25 billion in 21. That money technically hasn't come back. Their ownership level has dropped from 22, 23% to almost 18% now. So it can get front-loaded. There is a chance. Also, there is one technical thing of South Korea moving out of the emerging market index and becoming part of the developed market index, and that can vacate some space. But I think, last 10 years, they put more money in probably other markets than, India relatively, although the share in emerging market is still 15, 16%. So that's the risk, I think, which is there of FI flows returning. But let's see. I mean, the valuation may still hold them back optically, right? Because Nifty trades still at about 20 times. So that might hold it back. But we'll have to probably wait and see. But I agree with you there. That can be another upside risk to the market.
Right, that's about FII flows. But one last question, Gurmeet. We've spoken about so many themes, but if I ask you to pinpoint one theme, one multi-bagger theme for the next 5 years, what would it be?
So I like energy as a theme. India is adding about 50 gigawatts almost every year of energy, including clean and renewable. Our targeted number is 1,000 gigawatt, which means 450 additional gigawatts in the next 7 years. That's like 60, 70 gigawatts every year. Imagine the demand it creates for transformers, cables and wires, insulators, the grid, etc. So I think that's some theme I am extremely positive, and energy is needed even to support the manufacturing target we have, which is 25% to GDP. So that's the name I'm targeting. I think this is a theme which could really play well, and this theme got impacted by this ESG wagon also a lot. And now I think the world is realizing it's more affordable energy. It's not just clean. It has to be a combination of affordable and clean energy growth. So I think this space really, really excites me.
All right, Gurmeet Chadha, thanks a lot for taking out time and joining in and sharing your thoughts with us. It was a pleasure chatting with you.
Thank you. Thank you.
Well, with that, we've come to the end of this edition of Closing Bell. Of course, we are at fresh highs, nothing really to complain about. It was a thriller of a Thursday for us. We'll have to see whether or not we manage to continue this momentum into tomorrow. And who knows, within a few sessions, we could be staring at 22,000 levels. something that we have never seen before. But with that, it's a wrap from me, Nandita Khemka. Thanks a lot for joining in, and of course, have a great evening. Stay tuned to Money Control for all your other news and updates.